The biggest issue is that there's more spending than we have income, and that's a problem. The question is, where are you going to get the money from?
Ray Dalio is one of the most well-known macroeconomic investors in the world, having started Bridgewater Associates in 1975 and over time building it into the world's largest hedge fund. When Ray Dalio speaks, the investment world listens. And recently, Ray appeared in an exclusive interview on CNBC where he gave his updated thoughts on where he thinks the current economy stands, where we are in the short and long-term debt cycles, as well as where he believes the markets are headed over the next few years. First, let's hear Dalio's opinion on where we are along the economic cycle.
I mean, these things happen over and over again. We're now in the 12th and a half cycle. You know, these cycles, you know how the cycles work. You're 12 and a half cycles since 1945. 1945 was the New World Order, new monetary system. And you know what happens. You get a funky economy, weakness, and so on. So what we had, of course, in 2020 with the combination of COVID, and then also the move from the right to the left. There was a distribution of wealth. And so how did you do that? The government had to send out a bunch of checks.
Yep.
And the Federal Reserve, where did the government get the money from? The Federal Reserve lent it. So we have an imbalance. And of course, that put a lot of money in the system. You've got the demand, you've got the cycle, classic cycle, right? Stimulation, credit becomes debt. Then you have inflation. Then you have a tightness of monetary policy. And so where are we? So we now in a classic spot where we've got a relatively high real interest rate. Real interest rates went from minus 175 basis points to plus 175 basis points, right? You've got a cash rate that's relatively high. Cash used to be trash. Now cash is relatively attractive.
And if cash is relatively attractive, that means that the bull run is over, and it's becoming clear that we are well past the top of this economic cycle, and that we are experiencing the contraction of the economy. In the last 10 years before COVID, the economy was booming, where interest rates were down, unemployment was low, and money was cheap to access, which created economic expansion and optimism in the economy. But in 2020, we had a big shock to the economy. We had a lot of friction between political parties, and the US changed political leadership. The Federal Reserve printed a lot of money to combat the weakness in the economy, which stimulated the economy, but also created inflation. And now we've pushed a good economy as far as it can go. The government can no longer push the economic stimulus button, and as with all cycles, we now face the contraction.
You have the classic movement, of course, as rates go up and money becomes tight, you lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right? So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash. All of that comes down.
As the economy gets to the top of the short-term cycle, economic bubbles start to form. And as we start to go down, so does the entire economy, starting with the economic bubbles. It seems that we are still in the early stages of the economic contraction. As we're seeing right now, only the bubble areas are starting to be seriously affected. As the government begins tightening economic policies and interest rates begin to rise, money is being pulled out of speculative assets like cryptocurrency, venture capital, which is very reliant on credit, and speculative tech companies that do not yet produce profits. These are all signs of the early stages of an economic contraction. But as Dalio explains, things are beginning to get more serious.
What we have here is that there was quite a lot of bubbles in this. So you could see which sectors are going down. You could see which stocks are going down, right? You see the tech stocks, you see real estate going down. Residential real estate goes down, but doesn't mean that their families are hurt because the household sector is in a better financial position than it ever was. So you're seeing this type of contraction. So it's going down, and we're having something close to a let's say a stagflation, meaning maybe 3.5. I think you're going to see inflation come down to this, and then because of the way it's calculated, it'll go up a bit. And so you see that kind of an environment with something close to maybe a 1% growth rate.
Essentially, what Dalio is seeing happen is a stagflation environment, a combination of economic stagnation and high inflation, which is economic weakness at the same time as high inflation, which is a very unusual situation. Because usually, inflation comes as a result of a booming economy, where interest rates are down, unemployment is low, demand for products and services are higher, and employees start looking for higher pay. In other words, inflation comes as a result of a healthy growing economy. But stagflation is an unusual economic scenario where inflation is high in an economy that is struggling, where unemployment is rising, companies are not as profitable, and salaries are staying still. This is a particularly painful environment for the entire economy, especially those controlling the monetary policy, as actions to control inflation like raising interest rates that typically work in normal conditions will make a bad economic environment worse. And that is what Ray Dalio is currently anticipating in the US. As he said, he predicts inflation will not quite go back to where the Fed wants it. It might go down to about 3.5%, but it will eventually rise again. At the same time, he also sees the economic growth staying quite low, as he said, about 1% annually. So we should expect slow economic growth over the coming years. This is what is likely to happen with the short-term debt cycle. But on top of the short-term debt cycle, we also have the long-term debt cycle that rises and falls about once every 75 years. And while everyone is currently focused on the short-term debt cycle, Ray also cautions that he is seeing problems emerge from the long-term debt cycle that has been developing since 1945.
But what's also happening in that cycle, since 1945, is that we then have the accumulation of a lot of debt and money. Okay, so we deal with things like the debt ceiling. Does the debt ceiling matter? Does it matter how much debt we have? And then you have a situation where there's used to be a free market supply-demand, but now you've got the Federal Reserve who is now taking it, buying it on the balance sheet, so it's not the supply-demand. So you've got that dynamic very, very classically going. I don't think people are paying enough attention to the big cycle. There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years. Plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt. And then there were issues in terms of the issue of the dollar and what's happening in terms of the world and the value of money.
Over the last few years, the US government has seen a significant increase of its national debt due to the economic impact of the pandemic and the lockdowns that stopped people from working. So the US government had to very quickly inject a lot of money into the economy to ensure that people still had money. This, of course, came in the form of stimulus checks to people and businesses, but also came in the form of a major growth investment like infrastructure projects to create more jobs. But how did the government get all this money? Well, the government borrows money by issuing new government bonds, in other words, debt, and selling them to the Federal Reserve, which prints new money. So the US government went further and further into debt by selling new government bonds to the Fed, who printed about $4 trillion of new money, which then triggered the massive inflation we're seeing today. But the problem is that the US continues to spend more money than it earns. And because the debt ceiling is already being hit, they can't add new debt to replace the old debt. So now there's a small fear that the US might default on their debts, which would trigger the downslope of the long-term debt cycle as the debt burden becomes unsustainable. The US also faces a problem of reduced demand for their newly printed bonds internationally, which also adds to the issue since less people are willing to buy US debt, making it harder for the US to raise money. While there's no crisis yet, some wheels are in motion that can trigger the downslope of the long-term debt cycle. So, how does Ray Dalio see the situation play out over the coming years?
But I think that this type of recession is not a bad recession. It's a lot less bad than I thought it would be because of the fact of how it's distributing and shrinking that credit. At the same time, though, we have a real issue for the United States debt in the world, because we're selling all this debt. You know, if you look at wealth instead of GDP, wealth is a much better indicator of things. GDP is like looking at revenue. How much did you sell? We have borrowed a lot of money, Okay, and now we're having a problem selling that money around the world.
Right.
And it's also happening that this political situation, geopolitical situation, is weakening the demand for U.S. bonds.
The good news is that this recession is not as bad as Dalio anticipated, but he is concerned that these issues around the U.S. national debt, the current deficit, the debt ceiling, and the weakening demand for U.S. bonds are becoming a problem for the U.S. and the global economy.
I think the biggest issue is that there's more spending, and I would say there probably needs to be more spending than we have income. And that's a problem. Governments run the same as your household or a business in that, with two exceptions. They can print money and they can tax, right? So then when you spend more than you earn, the question is, and they're going to spend more than they're going to earn, where are you going to get the money from? Are you going to get it from taxes? And if you get it from taxes, people fight because they don't want to give up their money. Or are you going to get it from printing the money? And so how do you achieve that balance? Because do you spend less?
Right.
Well, it's a tough environment to spend less. You have to spend more on defense. You have to spend more on rebuilding. The Green Initiative is expensive. I mean, education is expensive and so on. So there's a dilemma that she is sitting in, that we as a country are sitting in. So how do you solve that problem? There's a lot of things that you can invest in that will produce returns. For example, I don't think we invest nearly as much in the basic things like great education. Invest in those things that are going to produce productivity. Education's a good thing. Infrastructure's a good thing. Other things. But this is part of a cycle, a big cycle that has happened over and over and over again.
The major problem in the US is that the government is spending more money than it makes, but not enough on the things that make the country more productive, like education and infrastructure, which helps close the deficit and reverses it over the long run. Dalio also talks about his thoughts on where he sees the stock market at the moment and where it's likely to be in the future.
To me, it looks like that you have something, substandard growth, right? You have that, when we call it a recession, I can't tell you, is it 1% growth or something like that, but it's a fairly stagnant growth that is not hurting the household sector as much as you would think in terms of that. So that becomes tolerable for longer. So then you look at the markets as a whole. So now you're going to have probably a tightening or a tighter monetary policy than existed, and that's a net negative for the stock market, but not in such a big number that it's like a big bearish thing. So when I look at the market as a whole, I would say, okay, well, now it seems closer to fairly priced, probably still a bit high, given that whole picture.
And there you have it. Since Dalio still sees problems for the future of the economy, he still thinks there will be negative pressure on the stock market for the foreseeable future. But overall, guys, these are Ray Dalio's updated thoughts on the economy and the stock market for the current US economy. Do you agree with Ray Dalio, or do you have different thoughts about the economy? Let me know in the comments below. Thank you so much for watching, guys. If you enjoyed this video, give it a thumbs up and consider subscribing if you haven't already, and I will see you in the next video.